Turning now to our top story, who's heeding the Fed? High interest rates at the center of the failure of banks like First Republic come even as the Fed warns of a possible recession. The market may not be taking these warnings seriously enough, and the next dip might be just around the corner. Joining us now, Gareth Soloway, Chief Market Strategist at Verified Investing and Chief Market Strategist at In the Money Stocks. Good to have you on the show here. So, are you surprised that the markets aren't heeding the Fed at this point? I mean, even when we're looking at the VIX, even that's down 1.2% today at 15.
Yeah, it is a little surprising. I think this is part of the market cycle of complacency where the markets overall, we just came off of this big drop from 2021. And investors are starting to say, okay, the Fed may be looking to kind of pause here. They're still likely to hike at least one more time. But ultimately, the markets are getting ready for this pause. And I think that's drawing a lot of investors into the market. And you kind of create this scenario where investors, like you said, are ignoring the Fed. The Fed has said there's going to be a minor recession. The concerning part to me is that if they said minor, and last time, remember, they said, we would have this minor kind of issue with inflation, right? We were going to see transitory inflation. It ultimately turned out to be horrendous. And so I am concerned that investors are mispricing assets here. We see Pepe on the crypto side. We see the crypto runs going on again. And this is telling me that there's a lot of risk in the system.
And so people are taking a look at this, but then, as you mentioned there, markets really looking ahead to a pause and a pivot. But in reality, when you're looking at some of these indicators like inflation and unemployment, some of these stickier parts of inflation in particular, where do you see perhaps a pause or a pivot coming in?
Yeah, I think the Fed is starting to pay attention. We saw the last jobs number getting a little bit on the weaker side. It came in slightly lower than expectations. We've seen inflation coming down, and we've seen the banking crisis really continue with today's takeover by JP Morgan of FRC. So I think the Fed is aware of this. They don't want to kind of stop too quickly on the hiking side, so they're going to likely hike by 25 basis points next week. But I do think it's then open-ended, and the Fed may be looking to pause. The issue for the markets is that the market has always, and investors have always looked at it and said, hey, the Fed will bail us out if we get into trouble. The problem is in the past 15 years, inflation was sub 2%. We're now at a point where inflation is north of 3, 4, 5%, and the Fed can't bail us out. And I think that's where the mispricing of these equities is coming in, where you have NVIDIA where it is, you have Apple, you have Microsoft. All of these sky-high valuations are not pricing in a recession later this year.
So then when you combine what we're seeing with valuations, people are looking ahead at perhaps stagflation versus a recession. What is your take on that, and which one could potentially be more hazardous for investors?
I think the stagflation is a big issue, right? If we look at how stagflation attacks people where they're not getting more pay, they're actually in a recession or the economic growth is stalling out, but inflation is continuing up. That makes it very problematic for them to start spending more money as inflation on goods continues to cost them more money. So I think that's the bigger problem here. And I do see that as a forecast of what could happen in the second half of the year, where we still see inflation, even for the next couple years, maintaining 3, 4%, but you do have a recession that drags on for multiple years without the Fed stepping in. And again, this is the kicker, is that investors continue to think that the Fed will bail us out of every situation, but we clearly hear from Jerome Powell that that's not likely the case unless things get really, really bad.
And to that point, you're expecting the stock market to drop about 20% potentially by the end of the year when reality does set in for investors. So how should people be positioning themselves so that they don't end up with a shock to the system?
Yeah, and that's a great question. So I think for me, it's looking at kind of defensive plays, right? You look at plays like gold miners. Miners took a big hit last year relative to the price of gold because inflation was so high. Their input costs were going up, but the price of gold was not matching that inflation. Now gold has started to take off. We've seen gold trading close to those all-time highs. I think gold does break out in the second half of the year. And I think you look for defensives that haven't run. We've seen the McDonald's have run already. We've seen GE is sky high. That's kind of being played as a defensive. We've even seen Apple as being a defensive. I think you start looking for the biotechs like the Amgens. People will still need drugs if we go into a recession. I think that's the angle. Play the beaten down defensive names and ultimately the gold and gold miners.
And for people who are trying to gauge sort of where we are in the market cycle, the cycle psychology chart and how that's matching with what we're seeing with the S&P 500 potential here. When you look at where we could be headed at the moment, how far out do you think that anger phase is going to start kicking in?
Yeah, and this is amazing if you do, and you guys are showing it right now. If you look at the S&P 500 on a weekly or monthly chart, it matches perfectly up with just after the euphoria phase, that sideways to up consolidation that we've seen in the S&P for the last really 6 to 8 months. And that tells me we're in this what's called complacency stage, and it's just before the roll off of the cliff, which comes into that 20% downside projection in the market. So I think you could be looking at 6 to 12 months of pain in this market coming forward, and investors need to take heed. You're seeing things again like risk taking in the crypto markets, in the stock market with sky high valuations, and that is not the sign of a bottom in a stock market or in the crypto markets. It's a sign of a near term top.
Yeah, when I saw that Pepe the Frog coin only launched 2 weeks ago, it is already now by market cap one of the top 100 cryptocurrencies. Yeah. It's certainly alarm bells going
Scary.
off. A big thank you there to Gareth Soloway of Verified Investing and In the Money Stocks. Thank you for joining me this morning.
Thank you.